Hey there, traders and investors. Bennett Tyndall with TradingAnalysis.com. Today is Tuesday, February 2nd, 2021, and this is your weekly public market update. So last week, we were tracking the makings of an ending contracting variety diagonal in the S&P 500, and I was anticipating that to yield a larger market correction. And in fact, we did complete the ending diagonal, just 20 points of our upside objective. Our upside objective has been 38.90. That's simple 5v1 equality of the impulsive trend off of the March lows. We came 20 points shy of that. We met channel resistance. We completed the 5-wave contracting variety diagonal, and we did roll over to the tune of about 4.5% in the S&P. However, I stayed out of the short side of the market, and you might be asking yourselves, why on earth didn't you expect that to be the start of the larger pullback? Well, if you follow me on Twitter, I posted the fact that the move off the top unfolded in a perfect measured move fashion. What that means is it was a 3-wave measured move trend, and 3 waves does not a trend make, or in this case, 3 waves does not a trend break. So you might be asking yourselves, my goodness, how on earth can we continue the subdivision of this trend given the fact that we have a lot of overlap within this move and it's just overall been a very tricky count? Well, let's talk a little bit about that. I feel we've done a fantastic job of identifying the 4th wave corrective pullbacks as buyable opportunities. We've been forecasting those pullbacks to yield new highs. The indexes have continued to deliver. But what kept me out of the short side, and how can we extend this trend? Well, number one, I had identified 3 signs. Sign number 1 was divergence of the put-call ratio as indicated by its 9-day simple moving average. Number 2, I was looking for a completed 5-wave advance in stocks. And number 3, I was looking for a completed 5-wave decline to the downside in the dollar. We had 2 of the 3 triggers met. However, when only 2 of your 3 triggers are met, with many of the index heavyweights such as Amazon still in healthy consolidations that have not met their previous highs, that tells me that this initial move off the top is likely just a fake out, and we do break into new highs, and that's when we'll see the larger pullback set in. And typically speaking, that's how these sort of trends unfold, or that's how these sort of trend reversals happen. You have some sort of an initial move to the downside. Typically, you'll trap retail short traders here. Big money steps in, ramps the market back up. Retail shorts get stopped out of their positions. They then doubt their analysis. Their conviction level disappears, essentially. And they then not only get stopped out of their short position, but they then flip back to the long side of the market. And just about then is when the real top sets in. So let's jump into the subdivision of this trend. Let's go ahead and talk about the pullback, first of all, that we saw. So let's get down to the 15-minute chart. And I want to point out this move off the top, because the move that we see here is a pretty straightforward 3-wave measured move. And what that means is oftentimes corrective legs of the same degree will tend towards equality. So if you were to take the magnitude of this A wave and project it from your B wave retracement, you'll notice that takes you down to 36.93.52. The market low was 36.94.12. 36.94.12. Not even a dollar difference in a 3,600 point index. Really, really rather remarkable. So 5 down, sharp B wave back, and a measured C wave decline. So when that 3-wave measured move hit, found support, and I saw a lack of confirming indicators, I wasn't interested in jumping in the short side. In fact, I had emphasized to our members, you need to be patient when looking at these sort of trends. Let's quickly look at the dollar, and then I'll take you through the subdivision that we have here. So over to our wave count in the dollar, you'll know that our preferred interpretation has been looking at this as a wave 4 position. So it was a little bit confusing, in fact, when we had the ending diagonal complete in the market, in the S&P, in the as well as the divergence of the put-call ratio. Now, resistance here at around 91.11, we do feel will yield a retest of the downside 88 support level. Okay. Alternatively, if we are going to, for some reason, roll over and we don't break through the 38.90 previous high, the only way to look at a trend reversal as in development in the dollar would be to view this as an expanding diagonal in 1 and a 333 sideways combination correction. I really don't think that's the case. This to me looks a lot more counter trend in nature, and I do think will yield a move lower. The put-call ratio, which is one of the 3 signs that I'm watching for, you can see the green 9-day simple moving average still tracking under the previous extreme that was set back in December of last year. So this is still valid as one of the indicators that I will be using. So I'll be looking for the divergence here. I don't want to see the new high in the market be met with a new extreme in call buying. I want to see a lower high than the previous December 7th extreme. I want to see the 5-wave decline in the dollar complete. So I want a 5-wave subdivision here. And then back to the S&P. Let's talk about how this trend extends. Well, essentially, what ended up happening is, as opposed to this being all of orange wave 5, which, given the 61% relationship to 1 and 3, it did appear to actually be orange 5. What ended up actually happening is, as opposed to that being all of orange 5, this is your orange 5th wave. So everything gets moved one swing point to the right, and I'd say north of the December 21st price level. So moving that 3rd wave here, moving that 4th wave there. You'll notice when we do that, we still end up with an ending contracting diagonal. So it was in fact an ending contracting diagonal pattern. It was just of a smaller degree trend. You'll now notice this 4th wave is about 138% of the magnitude of correction in green wave 2. And it was beyond a 38% retracement and about a 50% retracement of this 5th wave. Now, if we take a look at our 38.90 upside target, which is, again, equality of wave 5 and 1 originating off the March low, that now lines up with an external 127.2% retracement of the 3-wave measured move decline that we just printed this week. So there's your upside resistance zone. You've got a 30-point window of resistance between 38.90 and 39.20 to be watching to get that market top underway. I do still think we end up printing a market correction. I do think a wave 2 correction is in store. I still stand by my analysis, which suggests it will be a buyable correction, but we're just not there yet, okay? Just not quite ready to get underway to the downside. I want to point out something here in this move in wave 5. Going back to the February 2020 market top, you'll notice that initially we had this as 1, this as 2, this as 3, this as 4, and that appeared to be wave number 5. We then printed a 3-wave decline to the tune of about 3.7%, and we then ramped up into new highs. You'll notice everything got moved over one swing point to the right, very similar to what I just showed you. And in fact, that 4th wave was 138% of this wave 2, and it was about a 50% retracement. I think we are in a very similar situation where we push higher in the 5th wave, and that's when the larger correction sets in. I'll be sure to keep you updated as the trend unfolds. Thank you guys for watching. You can check us out at tradinganalysis.com, and I will catch you on the next video update. Take care.